My name is Tabitha, one of the IRA specialists here at NewView, and today we are going to be talking about building wealth through investing in real estate within the IRA. So, disclaimer, as always, NewView Trust serves as the custodian for alternative assets. We do not provide investment advice, legal advice, or any investment advice. We custody IRAs, ESAs, HSAs, and 401ks that hold alternative assets that are directed by you. So what is a self-directed IRA? As always, a self-directed IRA is an IRA in which the individual chooses their own investments and directs their assets into alternative assets. Anything outside of the stock market would be considered an alternative asset. Things on the traditional stock market or investments would be traditional stocks, bonds, and mutual funds. And here at NewView, we do alternative assets, so anything that's not publicly traded on the stock market. So what are the benefits of a self-directed IRA is true diversification. I would say about 50% of our clients have accounts maybe at Charles Schwab or Fidelity or Vanguard where they are invested in traditional stocks, bonds, and mutual funds. But then they come here to NewView where they're able to, maybe make different assets or investments that they're already making inside of their IRA account, things like real estate or notes or private lending for those tax savings on those investments. And they always say the biggest piece of advice for when you are investing is to invest in what you know best, because you're going to be able to do your own due diligence and know what return you're expected to get without having to rely on somebody else to do that for you. So investment restrictions, there's only two things that the IRS says that you cannot invest in inside of your IRA, which is life insurance and collectibles. Because when you're investing in life insurance, you're kind of investing in your death, which defeats the purpose of investing for retirement. And collectibles, so things like cars or art. And that's because the value of those things might vary from one person to one person. And there's no true valuation of those. So today, of course, we'll be talking about the real estate options. There's so many different real estate options that you can invest in with your self-directed IRA. So let's take a look at that. First thing would be private entities or limited partnerships or joint ventures. So this would, as well as limited liability companies or syndications or trusts. This would be groups that are raising capital maybe through individual investors or partnering in deals so that way they can do a much larger deal and hopefully get a better return than just doing a deal by themselves. Private lending. So this is a great asset class because you're able to be a very passive investor where, a lot of people, they might, especially real estate investors, they might need extra bit of capital for a deal and they can't access it anywhere. So that's where you would come in. You can become the bank and do private lending. So, you and the borrower or the lender and the borrower would agree to whatever terms that you guys would for that investment. You can do either a secured or unsecured note. Secured means that you're loaning the money at whatever terms you guys agreed upon, but you secure that investment or collateralize that, usually by the property if it's for real estate. So in the event that the borrower defaults on the loan, you foreclose on the property and then own the property inside of the IRA. Unsecured obviously just means the note is not collateralized by anything. So in the event the borrower did not pay you back, there would be no security for that investment. It would just deplete. So rentals, Airbnb would be like renting a property and then renting them out for either single family homes or having an Airbnb property where different people are renting it out every year, maybe for vacation or travel or what have you. Foreclosures, so this would be houses that are getting foreclosed on. You can go invest in these properties and usually buy them at a cheaper price. So tax liens would be when, say, for example, somebody owns a property. Each year, at the end of the year, they'll owe taxes on this property. Sometimes it can be a couple of thousands of dollars that people don't have to spend. So this is where you could come in, and this is another aspect to private lending, where you would be able to loan them the money to pay those taxes. And in the event that they did not pay you back or they defaulted on the loan, you would be able to foreclose on the property. From my understanding, it is a long process, but that's the way that it would work. Fix and flip, so buying maybe a distressed piece of real estate, fixing it up, and then selling it for a much higher or better price. Real estate options. A lot of people don't know this, but when it comes to real estate options, say, for example, there's a property that you know that you want to own in a couple of years, and maybe somebody elderly or somebody who's really just looking to get out of that home in a couple of years, you could go to them and say, hey, I will give you $25,000 today to agree that in 5 years, you allow me the option to buy this property at whatever set price that you guys agreed upon. So that way, the person that's getting out of the property will benefit by getting that cash up front. And then you'll benefit because maybe in 5 years, that house will be worth a lot much more, but you still have the option of buying it at that set price that you guys agreed upon. Condominiums, the same thing. You can rent those out or Airbnb them. Unimproved land is a great investment because land, they're not making any more of it. So whatever's left is what we have to invest in land. Commercial property, so this would be buying family offices, commercial offices, and offshore real estate. Most people don't know about this, but you're able to create an LLC for your IRA. And then that LLC is able to invest in offshore real estate. That's something called checkbook control, which we have gone over in a few other episodes, and I'm sure that we'll be going over again. And if you want to learn more about that, we'll be happy to hop on a call and explain that more. So single and multifamily residence rentals. Why would we want to invest in these? Well, cash flow from renters monthly, long-term appreciation for holding onto that property, and passive compared to other real estate investment types. You would hire a property management company, or you could even manage the property yourself. The only things to consider is that you won't be able to live, work, or stay on the property, or have any prohibited party live, work, or stay on the property. And we'll get into a little bit more of that later. So how would we make these types of investments? It's as easy as once your account is open and funded, you'd find the real estate deal that you're looking to invest in and fill out a purchase authorization form and provide us any supporting documents, so the contract or the deed. Another thing to keep in mind when we're thinking about buying real estate inside of the IRA is that the IRA is actually purchasing the property. It's not you personally. So on the title or on the deed, it would read New View Trust Company, FBO, and then your first and last name. So you'd locate the investment that you want to find, fill out a purchase authorization form, fill out any supply us with any supporting documentation. And of course, when you're buying a property, you'll have to get it inspected. So you have to hire a professional, somebody that's a non-disqualified party that's going to give you the fair market value of that property. And make sure that you're acting on these before you lose it. Just like every other investment, if you're waiting too long, somebody might take that opportunity from you. So things to consider: location. When doing your due diligence, make sure that you're researching the area that you're wanting to invest in. See if there's any, significant changes that are coming up or any significant buildings that are going up that might appreciate the value of those properties. Did you negotiate the best possible price? Will you be able to keep this property rented? That's a very important thing if you're looking to invest in a single or multifamily home and you're expecting it to be rented. What is the market like in that area? What else is around in that area? Is that property going to be able to stay rented? So short-term rentals and Airbnbs, very similar to the last topic that we talked about. All the process is exactly the same, except it's short-term. So instead of renting it out for maybe a year at a time, you're renting it for a couple of days to a week at a time. So single multifamily residents purchase for the purpose of listing a short-term rental on platforms such as Airbnb. Why would we want to do this? Again, cash flow from renters. So you're going to see that money going back to your IRA every time that somebody rents out this property. Long-term appreciation from buying and holding the property. So of course, over the time, that property will appreciate in value. And you'll have a much higher income potential compared to medium or long-term rentals, because with Airbnbs, the pricing is a lot different. So obviously do your due diligence and know how many months out of the year is this property going to be rented. Um, just do your due diligence on it to know what type of return that you're going to be expected to get. So same process as before, you'd find the property, purchase the property, prepare the property for any renters by furnishing the property, list the property on Airbnb, manage any of the bookings, and manage the upkeep of the property through either managing it yourself or through a property management company. Again, you cannot be the one to provide services to your property. So you'd have to pay somebody, usually a 1099 or something out of the IRA, a bill pay in order to get that property fixed up. So fix and flips, single or multifamily residents purchased ideally at a discount for the purpose of improving and selling for profit. So maybe there's a property who the flooring in there is bad and the sinks and bathrooms look awful. You'll buy this property, you'll fix up the sinks, fix up the flooring, make it look like a super, appreciate the value of the home by fixing it up and making it look better, so that way when somebody else sees it, they're going to want to rent that. They're going to want to buy it at a much higher price, hopefully, that you have bought it for. So there's a large spread between the sale price and the purchase price or after repair price, and short-term deals and the ability to redeploy capital. So the good thing about the fix and flips is that you're able to do a lot of deals in a year, because maybe it only takes three or 4 to 6 months to fix up the property and then sell it for a much higher price than you bought it for. So then you're able to do your next deal because you've sold this property, and then now you are ready for your next investment. So same process, you'll find the property, purchase the property, fix up the property, and then sell the property. So things to consider: who's going to be doing the repairs on this property? As we mentioned, it cannot be you. Did you negotiate the best price? Will you be able to find a buyer? And do you plan on using any financing? Syndications. This is a super passive way to invest in real estate if you're looking to invest in a bigger deal. So investing into a business partnership or entity, LLCs, LPs, etc., who then invest in a variety of assets, usually real estate related. So people that are maybe trying to do hotels or mobile home parks or car washes, they'll be raising capital through individual investors like yourself to do a much bigger deal. So instead of it being one person that's buying a piece of property, there might be 100 people or more buying a property. So you'll have cash flow from the renters, appreciation in value, and it's super passive. So the investor does very little, more than just fund their portion of the deal and see their money appreciate in value and see their income coming in from those syndications. So how are we going to find these types of deals? Networking. Networking is super important for these types of deals, because syndications are usually private deals, thus requiring knowing someone or knowing where to look. We always like to put out there the RIAs, so Real Estate Investor Associations is a great place to find these types of deals, conferences, podcasts, or really any networking event. So things to consider with these is investing in an entity limited to accredited or sophisticated investors. So usually what that means is with these types of investments, investors are looking for, the minimum capital deploy of about $50,000. So, if you do some research on what an accredited or sophisticated investor means, it's usually somebody that has experience investing or they have a lot of money to invest. So will the investment trigger UBIT or UDFI? And what is your exit plan? Could you liquidate if necessary? So that's the number one thing. Usually with syndications, they're about 5 years long, and you have to know if there's going to be a way that you can sell your position in that, or if you're just stuck in there for those 5 years that it's going. So And the UDFI and UBIT we'll talk about later. Unimproved land, the purchase of land with the goal of selling for a profit to other investors or developers. So that way they're able to build on it or turn it into something that they want. But as I mentioned before, land isn't going anywhere besides getting sold and built on. So if you're buying raw land or unimproved land, you're going to be, you might be able to get paid a lot for that, maybe over the course of time. I know, for example, when I was working at my old job, I had some people come in and they've owned their property for 15 years, and an area close by that was getting bigger and bigger, and they were building more and more over there. They ended up offering them like a lot of money, way more than what they paid for that property about 10, 15 years later, for their unimproved land, because they needed that to build on. So why it's all speculation, whether or not if this is going to be a great area or if it's going to be booming in a year or two. You'll have long-term appreciation, so buying and holding this property, of course, and a low barrier to entry. So usually with unimproved land, it's a little bit cheaper than buying a piece of land with property on it, sometimes. And they're, like I mentioned, they're not making any more of it. So in order to make these kinds of purchases, you'll find the property that you're looking to invest in, purchase the property by filling out a purchase authorization form and providing any supporting documents, and then selling the property. So what are we going to want to keep in mind is location, location, location. Bonus areas that are likely to be developed or have population growth are really great places to look, because those are what's going to appreciate in value quickest, and you'll be able to sell for a much higher price. Did you negotiate the best price and buy and hold investment or plans for developing? And make sure that you're doing your due diligence on the zoning laws. They're different everywhere that you look. So when funding a real estate deal, there's 3 different ways to fund it. You can fund it 100% out of the IRA if you have enough funds in there to cover down payment or the investment and any expenses needed. Second would be a joint venture, and the third is a non-recourse loan. So let's take a look at what that means. IRA funding. 100% funding within the IRA allows the opportunity to invest with an individual, and you can use your own resources without relying on somebody else, expertise, and finances to secure the property by having enough funds to cover 100% of the purchase price plus any expenses that are needed. Why would you want to do this? This is, you use your own skills and resources, not have to rely on anyone else. This is your own type of investment, and you have the potential to gain profit on your own. So this is a great opportunity for people who maybe are already investing in real estate and they know what's a good or a bad investment, and they're just looking to utilize their retirement funds to invest in what they know best and eliminate taxes on the investments that they're already making. So how would we do this? Rehab a home or homes to make a profit, income producing properties that create passive cash flow, or buying and reselling the properties for a profit. Joint ventures. Joint ventures within the IRAs allows the opportunity to invest with other individuals and with their IRAs. Use your resources, expertise, and finances to collaborate and work together on a specific venture towards a certain goal. Joint ventures is really great. I would say I get questions a lot from maybe husband and wife who are looking to invest in something similar, but they're like, why can't we just pool all of our IRA funds? Well, an IRA is an individual retirement account. So if there's 2 of you, it's not individualized. So a great thing about the joint venture is if a husband and wife, or maybe even you and yourself, are looking to do a deal together, just for that extra bit of funding. Maybe you don't have enough in the IRA, and this extra bit of funding will make the capital gains on this investment a lot more worth the effort and time. So you're able to partner with yourself. You can partner with really anybody, even disqualified parties. You would go into the deal at whatever percentage that you and the other person will agree upon. Say, for example, that I wanted to buy a property and I only had 50% of those funds in my IRA. I could contact myself personally or anybody really who wanted to go into this deal along with me. It's just important to remember whatever percentage you go in at the deal, it's going to stay that percentage for any expenses and any capital gains. So for example, I am interested in purchasing this property and I only have 50% in my IRA. At that point, I would be able to go into the deal with myself at 50% with my personal funds. So the purchase price is $100,000. I pay $50,000 from my IRA and $50,000 out of my back pocket or my personal funds. And then say I'm fixing up this property and I want to replace the flooring in there. 50% of that expense would need to come from my IRA and 50% of that expense would need to come from me personally. Same thing when I'm renting out the property or any capital gains would be split at that percentage I went in at. And I'm just using 50% as an easy example, but you can use whatever percentage that you want. And it can be even more than two people. It can be multiple people. But any capital gains or I'm renting it and I'm getting that cash flow every month, 50% would go back to my IRA and 50% would go to my back pocket because personally I own this property at 50% and my IRA owns it at 50%. So also on the title or the deed, it would read New View Trust Company, FBO, Tabitha, 50% or IRA 50%, and then it would read Tabitha, 50% ownership. Really great for partnering if you have somebody who maybe has a little bit more knowledge when it comes to investing in a real estate deal and you have the capital but you don't have the experience, then you can join with somebody else who might have the experience and less capital, but you guys are able to help each other through that deal. So you're able to use your skills and resources for collaborative work, and you have the potential to gain profit, obviously, by investing into a larger deal or having more capital to invest in something that's bigger, so you're going to get a bigger return. And how are we going to do this? By rehabbing home or homes to make a profit, income producing properties to create passive cash flow. You're going to buy and sell properties for profit. The percentage of ownership will be listed on the deed, as I mentioned, and this percentage stays the same for any expenses or income on the property, as I mentioned. The only thing to keep in mind, though, is if you are doing a joint venture with a prohibited party or with yourself, your IRA would never be able to buy the other side out or vice versa. You personally would never be able to buy that 50% that your IRA owns, and your IRA would never be able to buy out that 50%. You'll have to think of an exit strategy where a non-disqualified party, that would be the only exit strategy besides, of course, selling the property. So non-recourse loans, this is a mortgage secured by the value of the property, not based off income or credit or anything like that. There's no personal guarantee. A non-recourse loan within the IRA allows for opportunities for the IRA to obtain a mortgage on a property. You would use the value of the property to secure a home loan, and the IRA will take a loan. Usually 30 to 50% down payment is required because it's solely based off the value of the property, and no personal guarantee, no recourse besides the lender being able to foreclose on the property to pay themselves back in the event that you defaulted on the loan for whatever reason. This is a great option for people who need an extra bit of funding and they don't have a partner and they can't find a partner, or they're just looking to do it on their own and get a non-recourse loan and get that extra bit of funding for a deal that they need. It's potential to gain profit by having that extra bit of capital needed. So you would be able to rehab homes or homes to make a profit, income producing properties to create cash flow, buy and selling these properties for a profit, and your IRA cannot be combined with any other loan collateralized by the property, including home equity lines of credit. Only non-recourse. No personal guarantee can be even close to an IRA investment because the IRA is a protected entity. So what is UBIT? Unrelated business income tax. It's income from a trade or business regularly carried on, showing frequency or continuity. Oh my God, I'm so bad. That is not substantially related to the purpose of a retirement account. So the unrelated business income tax was created by the Congress to level the playing field for businesses established under the umbrella of the tax exempt entity, not to have a competitive advantage over other businesses outside of the retirement plan. So UBIT applies to the following scenarios. If a business is partnered, is an LLC or any other investment that is involved in an unrelated business, income for the business that is gained from sales or services from the business, transactions or activities from the business that are not related to the tax exempt status, or if the business is regularly carried on by the organization. So is the UBIT paid out of the IRA or is it paid by the account holder? So the tax liability belongs inside of that IRA, not the account holder. IRA funds are used to pay the tax, not the personal funds. UBIT is calculated using trust tax rates, which are typically higher than personal tax rates. If there's an insufficient cash in the IRA to cover the tax, you can transfer or roll over funds from another retirement plan into the IRA to fund that. You can sell investments within the IRA in order to pay that, or you can make a contribution to cover the tax. If you personally pay for the UBIT from your own funds, the IRS will treat this as a contribution. And as we all know, you have those contribution limits for the IRA each year. So it might make your contributions off a little bit. So what is UDFI? If your IRA acquired a debt as a means to purchase an investment from the property, the IRA is considered to have acquisition indebtedness. So this would be if you got a non-recourse loan. If your IRA borrows money to purchase a rental property, the percentage of debt compared to the value of the property will be applied to the income generated by the property, after expenses are deducted, of course. To determine how much of the income is taxable, the acquisition indebtedness is taxed because without the loan, the IRA would have not been able to make the purchase of the property. So, for example, an IRA buys an apartment complex for $200,000. They use a loan to cover 50% of the purchase price, which is $100,000. If the net income from the rental property that is part of that loan is greater than $1,000, it will be subject to tax. The percentage of the property under the loan will be determined the amount of net income subject to taxation. This taxation continues if the loan is paid off in full. Strategies for diversifying your portfolio. We're going to want to think of different locations, changing it up, not just staying in Florida or staying in the place that you're from and what you know best. Getting out there, seeing where else in the world might be a great place to invest. You can even invest in property overseas. So property type, determine what type of property that you're looking to invest in, what type of strategy, and the risk profile. What risk is involved? What does the market look like? Is there an outlet strategy? Are all things that we're going to want to keep in mind. So what are the restrictions? So restrictions on IRAs, and the restrictions on the IRAs also include whatever investments that the IRA is investing in. So there are people restrictions, transaction restrictions, and investment restrictions. The IRS wants this to be a completely passive investment and for you not to get any other benefit other than the tax savings of that account. So people restrictions, this is a list of all of your prohibited parties or people that you would not be able to buy, sell, exchange services for, or do any work for any of their IRAs or vice versa. Usually any ascending or descending family members, so grandparents, children, grandchildren, and along with any of their spouses. Brother is not included, sister is not included, aunts, uncles, not on the ascending or descending lineage of the family. C corporation, anybody that you're in business with at 10% or more, and just your tax professional. You can take a screenshot of this and know which people that are restricted from doing business within your IRA. So for the transaction restrictions, you cannot buy, sell, trade, loan, or extend services directly or indirectly to any prohibited party. We get the question a lot. Okay, so I can't buy this property for my daughter to work in, but can um, my brother buy the property and then have my daughter? No, that's still a per se transaction, which means that you didn't per se break the rules, but you did it in an indirect way and you still made a prohibited transaction. Investment restrictions, as we talked about, life insurance and collectibles. So let's go over the things to consider again. Investment strategy, so your property type, location, rental income, and long-term appreciation of this property. Financing options, how are we financing this property, and any expenses that are needed for it. Management, are we going to manage it ourselves? Do we need to hire a property management company? Tax considerations, the type of account, tax considerations, the type of account, whether that's pre-tax or post-tax funds. Will my investment capital gains be tax deferred, or are they tax-free inside of the Roth? UDFI, which is the unrelated debt financed income tax. Will I be responsible for any of tax that I get for a non-recourse loan? And UBIT, is there any tax that my IRA would be subject to through this investment? And of course, doing your due diligence. So location, what does the market look like? The rental demand, potential for returns, associated risks, and your outlet strategy are something you're always going to want to keep in mind when doing your due diligence. Per se transactions, as we mentioned before, you didn't break the rules, but you per se broke the rules. And I don't know if a lot of people are familiar, but when it comes to investing, if you do a prohibited transactions, they're not easy. They're going to crack down on you in the event that you were to ever be audited and find out that you were doing a prohibited transaction or working with a prohibited party. They could penalize your IRA at 50% and forcibly distribute it. So if there's any tax consequences with that, if you're under the age 59 and a half, it'll be that 50% plus the 10% before 59 and a half penalty. Plus, if it's a traditional, then you'll be responsible for that added portion of that distribution, that forced distribution would be added to your earned income for the year and then also taxed at whatever tax bracket that would put you in. So there's pretty hefty penalties. I wouldn't mess around with the rules, but we always recommend that you speak to a CPA, financial advisor, or somebody, seek professional help. So here's what to do next. Scan the QR code if you're looking to schedule a consultation with one of our wonderful IRA specialists. Will help you determine the best account for you. But of course, when it comes to any tax or legal advice, we would recommend that you speak to a CPA or your accountant to determine that best account type for you. And fill out an application and transfer funds to make your contribution. Find your investment and then start self-directing your IRA. For any other options when it comes to following NewView or learning more information, we have all of these social media platforms and you can scan the QR code there. All right. Well, it was such a great class today. Amy, is there any questions?
Yeah, we had a couple come in. So the first question was, are there any restrictions on the location of real estate investments made through an SDIRA?
So there's no, other than the laws, you're able to find investment property even out of the country. It would just then apply to whatever their laws is would also apply to the IRA. So you're just having to make sure you do due diligence on where and what you can invest in legally. But inside of the IRA, there's many different options. I've seen people invest in Costa Rica, or maybe they live in Florida and they're invested in South Dakota. There's a lot of different opportunities and different options. So I would say the only thing that might tie you down is laws of other countries.
And then we had another question. How does rental income from real estate investments in an SDIRA get handled within the account?
Yeah, so when you're renting a property inside of the IRA and you have renters in there, the renters will be writing checks or they can send an ACH to pay that rental income directly to the IRA. You're never going to take that money yourself. They're going to write a check directly to your IRA or send the funds to your IRA. If they ever write you a check or you take the funds personally, that will be considered a distribution and you will be responsible for any tax liabilities that come with that.
Great. And then one final question from online. Can I designate beneficiaries for the real estate assets held within my SDIRA?
So you can designate beneficiaries for your IRA, not to specific real estate deals within the IRA. That would just be you setting whatever beneficiaries, whether that be primary or contingent. And I've seen a lot of people too create a trust, so that way the trust is inheriting, and then there's a lot less tax liabilities for the inherited person who has inherited that account. But we'll be talking about trust in a different video, so stay tuned.
All right, and those were all the questions from online.
Well, thank you so much for joining. As always, I'm so happy that I was able to share my knowledge